Hello, everyone, and welcome to the latest Hendricks Wealth and Estate Management webinar. I'm Jim Madl, financial advisor with Hendricks Wealth and Estate Management, and I'm glad you can join us live, or maybe you're watching the recorded version of this on YouTube or Facebook, or maybe right on our very own website at hendrickswealth.com. Today's topic will likely hit home for many of you as it relates to a harsh reality of not becoming a financial lifeline for your adult children. By the way, there is a Q&A button at the bottom of the screen for you to, if you have a question you want to ask, and we're going to try to answer all those at the end of the session. So let's dive right in. So many of us as parents share the same goal of wanting to give our children a better start or a better life than we had. And because of this desire, today's economic climate has turned many parents into the bank of mom and dad. According to recent data, about half of parents with adult children are still providing some sort of financial support. So you're not alone in this. But if it's not managed, this family business can become your biggest financial liability. This is largely due to some economic challenges or headwinds, such as increased costs for housing today, education, and just basic living in general. Today, we're going to look at how to be generous without being a lender of last resort that puts your own future at risk. When your child comes to you in a bind, your parent brain wants to say yes immediately. But this is when you need to engage your investor brain. I'll use the oxygen mask principle for this example. Just like on an airplane, when a flight attendant tells you to secure your own mask before assisting others, if you don't secure your own retirement or financial future first, you might eventually become a financial burden to the very children you're trying to help now. One of the hardest facts in financial planning is this: your children can get a loan from a bank for almost anything, a home, a car, a business, but no one will give you a loan to fund your retirement. So don't forget to secure your mask before assisting others financially. Need further reasons to secure that mask? Well, let's get into the numbers and look at the math. If you take $50,000 out of your portfolio today for your child's down payment on whatever that need may be, you aren't just losing that $50,000. You're losing every dollar that money would have earned in the future. That's the opportunity cost. And if we assume just, let's say, a modest 7% average return over 15 years, that $50,000 gift actually costs your future self about $137,951 over the course of that 15 years. So the question shouldn't be, can I spare $50,000 today? The question is, can I afford to have $137,000 less in my nest egg when I'm retired at the age of 75 or 80? So what can you do to assist in making this decision? Well, every bank has a lending policy, and you should too. It makes it much easier to say no to a request when you've already decided what you will and won't fund. I suggest a needs versus wants approach. Is this for a medical emergency or a health insurance gap? If your retirement can afford it, well, then that might be a yes. Is it to help them buy a luxury SUV that they can't afford the payments on? Well, then that should probably be a no. So you want to develop a green light, red light lending policy that outlines what will be considered, like specific needs, and what will be declined, like lifestyle creep, credit card debt, or those wants that are simply disguised as needs. And be sure not to just hand over the cash. Ask them to present their case. Have them document how much is needed and exactly what it will be used for. If it's for a startup of a business or for buying a house, ask to see their current budget. If they're hesitant or uncomfortable showing you their finances, then they aren't ready for a professional grade loan like they're asking from you. Subsidizing a child's lifestyle, like subsidizing their rent or mortgage so they can live in a nicer neighborhood, often does more harm to their future than good. It prevents them from developing the financial muscles they need to stand on their own. If they come to you and present a good case and you do decide to give money to your child or your children, how you label it matters. Is it a gift that you don't expect back? For 2026, the annual gift tax exclusion is $19,000 per person. So if you're a couple, you can give $38,000 to one child without even filing a gift tax return. Remember, though, these are dollars you are not expecting back from them. Is it a loan that should be repaid? If it's a loan, get it in writing. It sounds cold, but a formal note prevents memory loss and ensures that other siblings don't feel slighted. Nothing ruins a family holiday faster than when one child feels like the other is mooching off the estate. And even though you don't plan on taking them to court, a promissory note is essential. It moves the transaction from favor to finance. All right, disclose the interest rate. To avoid the gift tax issues with the IRS, you should charge your child at least the applicable federal rate, or the AFR. Currently, those rates are much lower than a bank loan, but enough to satisfy the IRS that this isn't a disguised gift. And develop a repayment schedule. Define the monthly amount and the start date. You can use an automated tool like Zelle or a recurring bank transfer so you're not constantly chasing them around for the money paid back on these loans. Another option could be to consider the early inheritance model. Tell them, hey, I'm happy to give you this $20,000 now for your house, but please understand this will be deducted from your share of the inheritance later on. It keeps the scales balanced and can aid in preventing or at least minimizing family conflict later on. Now, let's say you review your finances and you simply can't give your child money. The hardest part of this isn't the math, it's the conversation. If you need to say no, don't make it a lecture. As American author Anne Lamott once said, no is a complete sentence. However, to avoid sounding so brash and cold, you could try saying something like, I love you, but our financial plan doesn't have room in this or for this right now, without risking our ability to live independently later on. Or try something like, we can't give you the cash, but we can all down with our financial advisor together to help you build a budget. Sometimes the best gift isn't cash. Sometimes it's a session with a financial coach or financial advisor, or simply an introduction to a budgeting app so they can improve their own financial acumen. Teach them to fish. Don't just keep handing the fish to them. Your homework after today is to do a family audit. Look at your bank statements. Are you paying for subscriptions for your adult kids? And by subscriptions, I mean monthly costs such as cell phones, streaming services, car insurance, and the like. Second, run a stress test on your plan. If you gave away X amount of money today, how does that change your profit or your probability of success throughout retirement? We here at Hendricks Wealth and Estate Management would love to run those numbers for you. So feel free to give us a call. Remember, the ultimate goal in this isn't to be stingy, it's to be sustainable. Let's make sure your bank stays solvent for the long haul of your retirement. And again, remember to secure your own mask before assisting others financially. I'd like to thank you for attending today's session. Remember, there is a question and answer button at the bottom of your screen if you have any questions for us. I do hope you found today's content useful, and remember, we're here to help. So if you have any questions following this webinar that you don't get into us during the course of this webinar, feel free to give us a call at the office or send us an email to info@hendrickswealth.com. And while we wait to see if there's any questions coming in, I wanted to let you know of some of our upcoming webinars. Again, we do these weekly. So next week on March 4th, we'll have Jim Hendricks, and his topic will be thinking about hiring a financial advisor, why Hendricks Wealth. The following week on March 11th, Sean Hendricks will lead the webinar, and we'll be talking about 3 professionals you need in your life. And then on March 18th, one of our financial advisors here, Daniel Leitner, he's going to talk about what really drives long-term investment success. As always, you can feel free to sign up for those on our website at hendrickswealth.com. And there's an events tab up at the top that you can click into and register for any of our events there. Also, if you missed an event, we have a whole video archive on our website as well under the resources tab and then video archive. So you can go back and look at any old sessions that you may have wanted to attend but may have missed. All right, I'm going to give a couple seconds for any questions here. I don't see any coming in. All right, well, remember, if you do have any questions following this session, please feel free to reach out to us at info@hendrickswealth.com, or you can call our Illinois office at 847-428-3997, or our Florida office at 941-308-9862. Take care, and thanks for joining.